So now we'll be inviting George Walker.
Right, well, my background basically is I was an engineering academic for 20 years and I had another similar period in the reinsurance industry. And this is largely based on my reinsurance background. It is my opinion that the primary cause of the current issues with disaster insurance in Australia is the incompatibility between the high level of community flood risk tolerance and the low level of property insurance risk tolerance for affordability. Climate change can only aggravate this situation. Annual flood risks of the order of 1 in 100 or more are considered acceptable by the community, whereas building designers are required to design for annual risks of 1 in 500 or less for wind and earthquake. To be affordable, the annual risk to insurance companies of individual properties per hazard should be of the order of 1 in 500 or less. For instance, a property insured for $1 million, a maximum pure risk of the order of $2,000 or less per hazard, which would normally translate into an annual premium of the order of $2,500 to $3,000 per hazard. You can double that at least for overall premiums. Now, I propose to show why this flood insurance, severe flood risk, is uninsurable. Just a brief history lesson. Until about 15 years ago, flood was excluded from most home and contents policies. The increase in construction standards for wind resistance had made property insurance largely affordable. And following floods, however, the affected properties got the fact that they weren't covered from flood. And the politicians and media blamed the insurance industry. It happened after every major flood. The consequences were that the politicians required insurers to cover flood losses. The result was that property insurance became much less affordable and premiums have rocketed. Many policy holders have become very angry. And the politicians, media, and the public now blame the insurance industry. The real culprit is the mathematics of insurance. The typical probability density curve of annual insured loss as a ratio of its insured value, excluding flood, is as shown by the red line in this diagram. A high probability of zero or small claim and a low probability of a large loss. The mean annual loss is usually very small. The standard deviation is very large. This makes management of the property of the risk very difficult with this large, what we call coefficient of variation. Insurance is based on a theorem of statistics known as the central limit theorem, which states that if several similar risks are combined, then the overall mean annual loss per individual property remains the same at M, but the standard deviation of the combined risk per individual risk is reduced by the square root of the number of risks. In other words, if you had 10,000 risks, it would be reduced by 100. This is much easier to manage. Also, it tends to the normal distribution, and it's also easier to analyze. All insurance, including reinsurance, is based on the application of this theorem. It is what makes insurance work. However, it's based on some rigid conditions. One is the individual risks are the same property insured values, the same mean loss, same standard deviation, and the risks are independent. In practice, of course, this is not true. And if you don't satisfy these conditions, then the standard deviation of the combined risk will be larger than the formula value. Fortunately, for residential properties, excluding natural hazard risks, assumption 1 is approximately true, and the increase in the standard deviation is manageable. However, risks that are not independent are hazard events, because in a single hazard, all these risks fail at the same time. And assurers handle this by ceding the excess risk to the reinsurance industry. Insurers manage this pure risk by increasing the actual risk by something called the markup, a percentage, which covers the management of the standard deviation, admin costs, reinsurance costs, moral hazard, and shareholder return. The problem with flood is that for many properties, the mean annual flood risk is much greater than the mean annual risk from any other cause. And the result is it leads to a significant increase in the standard deviation of the total insurance company's portfolio. As a consequence, insurers are forced to increase the premiums for all policyholders, not just those at risk from flood. That's compounded by the fact that single weather events can produce large accumulation of flood losses over wide areas, which means you're adding further to the reinsurance costs, and it's made worse by climate change. And then, of course, in tropical cyclones, it's combined on top of the wind resist, so it increases the probable maximum loss of insurance companies, which again causes increases in the reinsurance premium rates. So we conclude then that the current level of accepted community flood risk makes flood risk uninsurable because it's incompatible with the underlying mathematics. Consequently, in the short term, property owners and the community at large need to fund these higher levels of risk, basically by taking the lower, or what we call first loss risk, and leaving the insurance companies to handle those large risks which have a mean annual loss roughly in line with wind and earthquake. In the long term, however, we need to increase the flood resilience of construction in flood-prone areas. One approach would be to make sure buildings were multi-story and the lower levels were floodable. Thank you.